Hello and welcome to Pro Trader Strategies Market Commentary for Monday, March the 28th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Quite a bit of market moving data coming out today, although it is a European holiday. French banks, German banks, Italian banks, every bank across the pond is basically closed today for a bank holiday, so may see a little bit less volume than what we normally would. But having said that, we have had a lot of economic data come out today that should be market moving. We had core PCE, which is personal consumption expenditures, and that index came in at 0.1%, which was lower than expected at 0.2%. Now, that along lines with Atlanta Fed coming out and giving out their GDP forecast numbers. They slashed it from 1.4% to 0.6%. Now that going under 1% is a pretty big deal. And on top of that, they revised, I should say, the January number from, I believe it was like 0.5% to 0.1%. So basically flat. So it's showing that we're seeing a slowdown in the economy from the fourth quarter of last year going into the first quarter of this year, because this is the March number. Going forward, that doesn't bode well for the overall economy. I think it was Mark Zandi at Moody's said that it doesn't make sense because of the job growth we're seeing. Well, if you've watched any of these daily market commentaries, you know I've been talking about how these job numbers look good on paper, on the headline number. When you start digging into those, it's really that the lower paying jobs are the jobs that are really putting people employed. Those are the discouraged workers, the people that used to have a full-time job and are now seeking part-time work, if you will, but now they're employed. So it makes that number look a lot better. Also, we have the discouraged the discouraged worker that is no longer seeking unemployment. So both of those added together is really making the jobs numbers look a lot better than what we really are feeling in the economy. So we're seeing this GDP, gross domestic product, come off. PCE, which is the personal consumption expenditure, come off. The PCE is a bit ahead, a few weeks ahead of the CPI number, which is rumored to be what the Fed really looks at. So this is kind of a precursor to that. The other thing that we saw was personal spending came off to 0.1% versus 0.2%. So that means the consumer isn't spending as much, despite the fact that we're seeing these lower oil prices and lower commodity prices, which is not good and really signals for a recession. And I've been talking about that for some time now. Personal income did uptick a little bit, but only to 0.2% from 0.1%. And pending home sales, which I've been talking about this, maybe people weren't getting off of their porches and going out and shopping for a new house with the thought that interest rates might start rising, really came in a lot higher than expected at 3.5% versus 1.2%. So that one does look like people are starting to shop for some homes. Plus, we're going into the spring season for homes, and that is usually when people start buying homes. Winter is usually a slower season throughout the United States for that data point. A couple of things that I've done today. Pepsi, let's look at the markets anyway first before I get into that. As you can see, this is just because I've been talking about crude oil so much, down just slightly today, below $40 a barrel. The NASDAQ right here just pushed back into positive territory since I basically started this daily market commentary right here at the point of control. It's really finding a groove right here. Market wants to trend sideways here. This is where the most time and volume has been spent for the NASDAQ, so it's really in its comfort zone. So it's going to take a bit of a push to get away from that. One would think that these economic data points today would have done that. And the E-mini S&Ps pushing into positive territory, as you can see here, up to and a half points right now. So the overall market's really trending sideways right now. This is the E-mini S&Ps on the 15-minute chart. So as you can see, in the last 15 minutes, we've really started to rally and push higher right out of negative territory. When I first started this, we were just slightly in negative territory. On to some trades that I've done. With Pepsi, I did this as the earnings setup, and I did a webinar on it, and I had on the April 1 weeklies with the April 4 weeklies, and I had on the 100 call calendar. And I paid $1 for that trade originally. So now that I've let those April 1 calls basically trade to almost zero, I rolled those out in time and went to the April monthlies. So I rolled my April 1 calls into the April monthly 100 calls to keep on that calendar. So I'm still long the April 4 weeklies on the 100 calls. And I collected another 51 cents for that. So now I have on those April 4 calls for about 50 cents because I rolled out in time and collected a little bit more credit for that. So trying to lower my cost basis on that, and was hoping to get that down to about zero. I have those calls on for free, but couldn't get enough credit for the April weeklies, rolling the April 1 weeklies out. So I just went out to the monthly on that one. So I have that trade on for about 50 cents going into that earnings call, or that earnings binary event. And if I can see that volatility expand, I'll get more money for those calls when that time arises. So hopefully I can get out of those before even the binary event happens. This, with the Qs, the triple Qs I put on, I bought some April 102 puts. And the reason why I bought those puts was just for a delta adjustment off of that GDP number. I was like, all right, I need to make a little bit more short deltas. Now, short deltas means I'm short the overall market. I don't want to be long the overall market if the economy is really flux in a recessionary type thing. We could really see the market come off a little bit. Although, on the other side of the coin, bad news is good news. So maybe this is going to say to the Fed, you can't raise rates. You don't have your GDP in line with what you have for your mandate, and they'll hold off because they don't want to start raising rates in that type of environment. That would just be pretty devastating to the overall economy in my eyes. So I did this as a delta adjustment, basically buying these 102 puts in case we get a bit of a pullback here. The expected move of the volatility is about 4 points, 4.5, or I think actually, sorry, 3.5 points would put it at the 104 mark. But if we start really seeing a sell-off here, then volatility should expand and bring that into the probabilities of happening. Now, GDX, this was from the webinar on Friday that we did on a short straddle with no upside risk. And what I tried to do with this is put on a straddle, take that credit that I'm going to receive for selling that straddle, and define my risk to the upside and not have any risk to the upside. So in this, I'm working this. It hasn't worked out very well. The overall market's down. It looked pretty in line on Friday and was going to be able to do it, on Thursday, but I held off. Used that as an example on Friday when the markets were closed, hoping to get in today. But as you can see, the market's down today, and it's not really accommodating me. So what I'm working in there is the April 26.5 straddle, and then for that I was collecting about $2.45 for that. Then I looked to buy the April 28.5 calls to define my risk to the upside. It makes that IRA a appropriate and gives me no risk to the upside. So that's why this strategy is so enticing. And for those 28.5 calls, I'm looking to have to pay about 50 cents for it. So it makes it, I could probably get filled at $1.95, but that doesn't cover my upside spread on that. So I'm working that overall package, the April 26.5 straddle with the 28.5 calls for $2. It's working, it's trading around $1.92.5 or something like that. So I haven't been filled on that yet. So just kind of working that right now, and we'll have to see if that comes to fruition. And I'll keep you guys updated on that. All right, that was a good one. So check out ProTraderStrategies.com because that webinar went off really well. We had a lot of people sign up for that, despite the fact that it was Good Friday. The markets were closed, but I think a lot of people got a good sense of how to build this strategy, define your risk to the upside, and make it IRA appropriate. All right, so go to ProTraderStrategies.com, sign up for that, and if you can't take that, take it easy.